as you suggest, institutions coming is a bit of a mantra. It's almost a little bit of a joke in some ways because they've been coming for a while. And I think when I think about it today, it's also institutions are coming, but institutions are becoming. There is actually a large number of folks who over the last decade entered the space, understand the digital assets fairly natively at this point, but have prior to that, 10, 15, 20 years of experience in traditional markets. And these guys are kind of forming together, including us, people like yourself, ourselves, various other folks, our industry colleagues, are all forming this pool of intellectual capital and also human capital, which is forming institutions in this space. So I think while the Goldman Sachs of the world will come, maybe, or are coming gradually, but the institutions that are being formed today are potentially will be the institutions that will that are built on these modern rails and eventually are the ones that progress the space.
Hello and welcome to another episode of RULEMATCH Spot On, the only podcast focused exclusively on the institutional crypto and digital assets industry. I'm your host, Ian Simpson, and if you want to know what banks, hedge funds, asset managers, prop trading firms, and others are doing in crypto and digital assets and how they're doing it, this is the place for you. My guest today is Omer Suleman. He is co-founder of Haruko. He has been in his career at many household names in traditional finance, Goldman Sachs, Deutsche Bank, Citi, as well as Lehman Brothers. He spent many years trading mostly derivatives, and he co-founded Haruko in 2021. He joins us from London, here in Zurich, in the studio today. Omar, welcome to RULEMATCH Spot On.
Thanks for having me, and really looking forward to have an exciting conversation.
I mean, we've heard in the past this kind of mantra that institutions are coming. Meanwhile, we know from one side that many of them have already been in the space early in crypto as well. At the same time, those who were early got into the space when it wasn't very mature. The market infrastructure and so on wasn't very mature. And, I think Haruko and also RULEMATCH, to be quite clear, are looking to help that. Can you just give us a little bit of a picture of what Haruko is solving for and how you see the institutional space?
Sure, absolutely. So Haruko is, just head on, I guess the bottom line summary of Haruko is building out modern tech rails for capital markets. Haruko is looking to build out the modernization of the technology stack that capital markets function on. In the context of institutions, going back to that question, is I think it's becoming, as you suggest, institutions coming is a bit of a mantra. It's almost a little bit of a joke in some ways because they've been coming for a while. And I think when I think about it today, it's also institutions are coming, but institutions are becoming. There is actually a large number of folks who over the last decade entered the space, understand the digital assets fairly natively at this point, but have prior to that, 10, 15, 20 years of experience in traditional markets. And these guys are kind of forming together, including us, people like yourself, ourselves, various other folks, our industry colleagues, are all forming this pool of intellectual capital and also human capital, which is forming institutions in this space. So I think while the Goldman Sachs of the world will come, maybe, or are coming gradually, but the institutions that are being formed today are potentially will be the institutions that will that are built on these modern rails and eventually are the ones that progress the space. Mm-hmm. So the way Haruko kind of approached this from the start is building out a portfolio risk management system was kind of the core of what we built out initially. But if I think about it, what we did was there's some very in the capital market technology stack. If you think about it, there's some very sort of like narrow things. Mm-hmm. They're very deep. you have to, for example, have an execution technology. It's very specialized thing to do. Similarly, and we can talk about custody and things, but in the digital asset space, there is the custodian technology, the MPC wallets, for example. It's a very specialized, very narrow thing. They're also very precise things, but then there is this whole kind of sea of things outside them. Everything that makes them kind of come together. This is, in the Goldman Sachs parlance, because I spent years there, is the SecDB, the securities database, the system that kind of basically spans everything. In the Deutsche Bank parlance, it would be the risk management system, popularly called RMS there. So every large institution has been built over the last 30, 40 years on these tech stacks, which do everything else. And Haruko started off doing everything else. And I think that's very sort of like, that's almost like one would say is the non-sexy part of the technology build-out, but it's critical. And once you build that out, almost everything fits in really nicely and almost depends on it. So if you want to modernize, or if you want to sort of have a fluently functional technology stack in the space today, that's the piece that one would have to build. So we started off building that, and have been, over time have built that, have obviously all the, large institutional players in this space as clients and enable them to kind of build out those businesses. But what we have done in the process is it's an asset agnostic stack, and we, separately also think of digital assets as kind of the more general case, the superset of assets in general. And while a lot of people for a long time, and maybe that thought process is changing, but almost thought of like a big set of assets that they hold, and in a corner within the same framework, they also have digital assets. We feel like, here's a new definition of assets, which is defined by digital assets, and it easily fits in anything else too. So that's how Haruko is set up, and that is now kind of, in a way, if I think about the mission statement of the firm over the last half a decade that it's been working on the technology stack and digital assets, it has now really changed to be the modernization of capital markets technology.
Very interesting, the point about institutions and institutions becoming. Maybe we'll come back to that, because there's some names, of course, that we know and share in common. Flow traders being one who probably fit in that category pretty well. But kind of the backstory of what you're doing, what you're building, obviously is to meet some needs that weren't there in the market, right?
Yep.
What was kind of the backstory of how Haruko got started in the first place?
Yeah. I think the three founders, Shamil, Adam, and myself, we had spent over a decade each in capital markets in various formats, ran FX options books, electronic trading businesses, and high frequency trading technology build outs in various firms. And then we started off, kind of got together, and we started off trading prop, and kind of not really stumbled upon crypto. I should say we were aware of crypto at that time. But for me, I would just simply say found something that was, rather than 5% vol in FX, was 150% vol back then. And it was very interesting to get into that space. So we kind of built out some trading in there. We traded prop and ran a fund in that space. And what we found was that while trading was very interesting and back then was exceptionally profitable too, but the thing that was really missing was a proper institutional stack, and as a result of that, we had to build out a ton of technology in house
for yourself,
for ourselves.
Yeah.
So we built out a lot of that, because there wasn't anything that I think if obviously I kind of blow my own trumpet, but I say if Haruko was there then, we may still have been trading as opposed to building out technology. So we kind of built out a ton of tech for ourselves. Then a few of our friends who were also hedge fund managers in the space, and they said, can we use your technology? And we said, no, but we use it. It's our own proprietary technology to run our risk on. So we can't really be doing this. And found people who were looking to, who made offers to buy out the firm to take out the tech. And finally, I would say we also realized, and this was kind of in the before crypto's previous winter, I should say, we found that technology firms in the space were valued at extremely high valuations at that time, whether it was something that was correctly valued or not. But importantly, that gave us the idea that if you build out the right set of tech in this space, there is a lot of demand for it because we were first-hand users and knew there wasn't anything that was very good. And two, both commercially, so it was a incentive to add to the world, but also add to ourselves, because I think if we created that kind of value, we would capture a lot of that. So that's how we then thought, okay, we should be taking this technology, productizing it, and commercializing this as a technology firm.
Mm-hmm. And those people that you say that were hedge funds and kind of trading firms that had that same itch, so to say, as you at the beginning, which you were in serving as initial clients. And like when you were starting to build that, were you looking to build kind of the things you knew from TradFi for crypto? Or did you come and see that there were some very specific kind of crypto features that you needed? Like, what was the intermix of TradFi features versus crypto-specific features, and how did that kind of develop?
I think I've always been quite agnostic to. So I don't think we were very attached to TradFi, even though we've come out of long careers in TradFi. At the same time, we were digitally native and crypto native, but not sort of very deep in the weed Bitcoiners or smart contract writers or anything like that. So I think we were in this place which was almost like an intellectual white space. Mm-hmm. We came in and we said, okay, what did we need to make money in this space? A lot of that was, for example, to be able to see our risk. Now, we were not judgmental on, the exchanges don't have fix, or till they have fix, we're not going to do this, or, WebSockets is not a good idea, or is it, or, all of those kind of things which are technology standards and things like that, we weren't judgmental on. So our idea was it was almost, as I say, an intellectual white space for us. Mm-hmm. Like whatever needs to happen to make things work, we will be doing that. And that's precisely what we had done for ourselves. And that's we knew from having done for ourselves that all the people who will be successful in this space would have this kind of common mantra of, it's not my line, but I've heard, and I don't remember the author, but it's the trick is not to predict the future, but to see the present very clearly. Mm-hmm. Mm-hmm. And I think that is really the trick. And we were, when I say we brought in everything that we knew from TradFi, so we knew about what kind of, how derivatives trade, how margin works, how kind of, settlement works, all of those kind of pieces. But at the same time, we understood, this is a new asset, it's scarce, it's not controlled by a monetary policy on one side. Then there are this plethora of assets which are being created on the back of that asset. Mm-hmm. Some of them are completely ridiculous in kind of what they purport doing and how they're set up and so on and so forth. I think we saw things, or I would like to think that we saw things very realistically. Mm-hmm. And so we brought both sides in. And as we built out this thing, it was a lot of it was initially for the CFI side of things, which mm-hmm. looks a lot like TradFi. Till in the 2020-21 time when DeFi became very popular and quite large and so on, and we did build out, and we still, as Haruko, as a tech stack, we run 50 different blockchain nodes and decode DeFi protocols and all those things. But I wouldn't say that we are biased one way or the other. Mm-hmm. We're very much a large institutional technology build-out firm. And if imagine all institutions in the world today decided that they're going to trade on Uniswap, we're ready. Mm-hmm. But instead, if they want to trade OTC derivatives, mm-hmm. we're there. Mm-hmm. And that's how the mantra's been. So I think it's definitely borrowing from both sides. Mm-hmm. And as I said earlier, I feel like we have now, not just Haruko, but all our colleagues, industry colleagues, I think we've now developed an intellectual space where we almost like we are at the leading edge of, I want to say, all of the capital markets technology and the way, for example, even on the trading side, a lot of the crypto trading firms are on the bleeding edge of this because they don't have this kind of holdbacks. They're in this free space, mm-hmm. and they borrow from every side that they can to progress. Okay,
and you're at home in London, right? That's
yes.
Where
yes.
Haruko is based,
yes.
and so on. A very interesting, of course, ecosystem and lots of institutions, lots of trading traditionally, and also in crypto as well. It's interesting talking about institutions. We had another podcast guest, I won't mention any names, but he was making the point that a large trading firm in London, based in London, to his knowledge, was now doing more trading in crypto than any other asset class, even though they had been early and in other asset classes way before. So in that sense, an institution becoming a new kind of institution, is kind of what you see also in London yourself and across other ecosystems?
Yeah, definitely. I think I obviously I definitely echo that sentiment. In London, I see a lot of that in the trading firms. There is now a push from a lot of the banks on build-outs, but I think the truth is that a lot of people are held back by a lot of regulation and those kind of things, but that's never been the driver of growth. If you, as an entrepreneur myself, you kind of recognize that there's kind of two things, right? There's the things to actually progress and the things to protect you. And the things to progress are not necessarily the main thing, but they are the things to protect are nice to have in some ways, because you could be lucky and you still get protected. But if you don't have a thing to progress, you're just not going to progress. Mm-hmm. So a lot of these firms on the trading firm side have the opportunity and have had the opportunity to having less shackles involved to go into that space and progress quickly and make enough money. So we definitely see a ton of that. We see large hedge funds in the space, large market makers in the space. Also, more and more I see, and this is kind of just mostly network public knowledge. Essentially, a lot of the firms that started off, let's say 5 years ago, a lot of the market makers, Amsterdam is a big hub of these, they started off thinking, and I think this is me sort of hypothesizing what they were thinking essentially, is because a lot of those guys created satellite firms to do crypto. And I think it made sense because I think the reputational risk of having crypto inside was much bigger and the opportunity wasn't proven. And also, importantly, there was no real, because institutionalization hadn't happened, there wasn't any real netting benefit of your balance sheet to that new operation in a way. So you still had to, you couldn't share even dollar funding between those two entities. And that has dramatically changed over the last 2 years, let's say. Mm-hmm. And I think, which is why I feel a lot of these firms, which initially kind of almost had little labs doing this, want to do this now in the parent organization, because it makes sense, because the reputational risk is a lot lower. Mm-hmm. In fact, the reputational risk from hiring young people and so on and so forth is actually that you're not attractive enough, you're not seen as forward-thinking enough. And there is now a lot of netting benefit. Now you can have, if you have your stable coins and your dollars on the same balance sheet, it actually you can get benefit of that. Or your crypto desk needs to settle something and quickly needs to borrow, rather than paying 16% to an outsider, they can probably pay you 7% to the internal treasury, which is normally lending out to its desk as 3%, and be done with this. So there is a lot of benefit that way, and so I think the ecosystem is definitely on the trading firm side in particular, but also I think more and more on the more active hedge fund side is definitely progressing to actually be doing something. I think the large banks are still a bit behind because they're still talking more, hiring more, having a lot of kind of fanfare around it, and the
process oriented
act of doing is still significantly less. But I would say we're in close conversations, not just for Haruko, but as industry colleagues with at least two of tier one banks who are very advanced in terms of actually doing something in the physical asset. Obviously, a lot of them are now trading in cash-settled derivatives, but in the physical asset space.
Yeah, very
in
interesting.
London.
And so maybe just to get to the nitty-gritty, when you go and have those conversations, what are kind of the, if you're going through an RFP process or whatever, and there's kind of a checklist, and you're saying, no, we're solving this for you. This is your problem. This is what you get with Haruko. This is going to make your processes more secure, help you in what you're doing. What are kind of the priorities or the checklist that these institutions are looking at when they're evaluating your tech stack?
I think so. It's from the perspective of the institutions. I think that I'd split them into two. The guys who actually are trading or are very close to trading. So they've put the right kind of people in place who are now both kind of know the space well and are willing to kind of take that next step of executing in that space. So either they're doing that already. So think of the large trading firms, large, kind of very active hedge funds, people who are physically trading crypto today. There, the conversation is of one type, which is essentially when we talk to them, what are the things that they want to obviously be on top of is how, first of all, a lot of the old technology has, or the vendors have kind of hidden costs in ways, because you deploy something and it's not even, I don't think it's intentionally hidden. It just kind of comes to fore along the process.
In the complexity.
Exactly. So you say, okay, here's a system, but you know what? To deploy it, you'll need to pay consultants, for 2 years. To actually deploy it, you'll need to hold servers or put this in the cloud. Oh, actually, by the way, cloud computing cost is outside of this, or this and that. So I think the way we've structured our tech is very much is like, here's a package. This is what it's going to cost you, and then it's there's very kind of cost angles to it, but it's a very contained, it's a very understandable set of what the technology is. The second thing, which goes long for most of the regulated guys, is how secure the stack is, what kind of security credentials we would have, how they would access, how engineers would access to update it, and so on and so forth. So there's all of those kind of things. But I think it's one of those things, once you do this once and the second time, it's a combination of, we're learning, we're obviously improving along the way, but also that they're learning. And sometimes they're learning about themselves, because in the process of let's say you have we've had many of these conversations. You have, for example, the CIO or the kind of the senior portfolio manager who's basically looking to do something with Haruko. So they need the tech, and the tech is put in place, and then they're like, okay, so is this secure? But actually, that starts opening up questions about what we currently do. How secure is that? So it's is those kind of questions come up for Haruko with these guys. But the other side of the conversation is with banks, where I think a lot of the energy and effort, both sides, is on kind of coming to that they should be doing what they should be doing. And I think on that side, I'd say, or people who haven't jumped in or jump in very slowly. One of the things they're keen on is kind of because I think there's a couple of things about it's a long-winded way to answer this question, but there are a couple of things about crypto which are very interesting. And if I really kind of bring it down to the core, there is essentially an asset which is scarce if we talk about Bitcoin, and it's cryptographically scarce, which is a concept that doesn't exist outside. So, everything else we can kind of think of, but this thing that, there's no monetary policy that you can change to govern this. So all of the risk of, lender of last resort or, creating more of this thing, all of those kind of things become very difficult. The other, so that's one, which is why custody and how you custody it is quite important, and that's kind of the risk that they worry about before they plunge in. And two is that it's the movements are largely on blockchains, on the main blockchains at least, are completely irreversible. So when you can't if you actually settle, it's done. And those kind of things are, the analogy I have in the real world is my daughter a few years ago came back and said, I got my pen license. And so, these 10-year-olds, but in a class would then be allowed to write with a pen as opposed to a pencil. And while a lot of TradFi, or what we call TradFi, is folks who will think that we've got these superior processes and we need to take them to the space which is crypto. There's also a lot for those guys to learn, because in a way they need to earn their pen licenses because they're used to writing with pencils. If you send me $1 billion, you can delete 3 zeros and it will become $1 million. But if you send me 100 Bitcoin, there's no way you can turn it into one again. So there is that thing where in crypto, while it's very nascent and a lot of it needs to kind of learn from TradFi for sure, there's also some reverse, right? So a lot of these guys in the banking space or in the more regulated space, I think there's a lot to learn from the space, and there's some nuances, some special risks which kind of are specialized to crypto.
We'll get back to the risk topic in just a minute, but speaking about institutions and about the nation, technology, what we found at RuleMatch is a lot of the banks, but not only banks, are interested in crypto. They've made money in crypto. They've been in it actually quite a while, and yet they're looking ahead, and they know that the next step is, as you say, modern capital markets, so tokenized securities, tokenized assets, real-world assets on the blockchain. I suppose you're having those conversations as well and seeing the same kind of thing, and you're prepared and ready for that?
Yeah. Yeah. So from Haruko's perspective, we've always, I think, one of the things that we've done is always followed where the market is. So as I said, look at present very clearly. So we are very much on the tokenization front. We essentially approach blockchain in a very holistic fashion. So if you've got anything that's tokenized, lives in a wallet, you can see it in your Haruko risk and bring it together alongside, other things which don't live in a wallet. So imagine you're an issuer, and we've got clients like that who issue ETFs or ETPs. So imagine that you're an issuer of a tokenized security. You hold the security with a custodian. You can represent that over API or directly by pushing into Haruko. So you can represent the asset that you hold, and then imagine that you issued some tokens on the back of that, and you just plug in a wallet that has that token, and now you've got the token and the security in the same place. You send that, which is the normal process of the tokenization. As a firm, imagine I'm an organization I'm an SPV that's going to tokenize something. I'm going to hold the actual security and then create the token so I can see both, and then I send the token to whoever's bought it. So essentially, and that movement can be tracked as well. So from Haruko's perspective, a tokenized security is very much like any other token on blockchain, which are all visible and can be kind of brought together in risk in a standardized fashion. And on the other side, we're very much like a Lego block for the capital market. So you can represent a security, a bond, an equity, just as much as you can represent a Bitcoin or an Ethereum or a FX cash balance in the same way on this side. So it's very interesting, this thing around tokenized equities in particular. I was looking at the sort of like the product details of an X stocks or various other for example tokenized equities. It's almost like, obviously it's a certificate issued. So it's like a fund. You've just created a fund in which holds the equity, and there are obviously clear benefits to this thing in terms of distribution and so on. And then imagine that there's dividends issued with that cash. You're buying more of the stock to hold it there because the token doesn't actually give any dividends, for example. So it's a very interesting construct. But from our perspective, we work with wrappers really well. Okay. Whether there is token inside and security outside, which is a tokenized equity, for example, or there is token inside and a security outside, which is an ETF. Both of those, and funnily, I think I was reading last night about the tokenization of ETFs, and that's token, security, and token on top. So we don't mind. We can have any layers of those kind of structured products or wrappers in.
And in the conversations that you have with clients or potential clients who are looking at these things, do they have a perspective on which is easier, which would they prefer? How do you think kind of the market is thinking about things? Because, of course, Robinhood comes with a huge announcement that we're going to tokenize everything, and now the SpaceX IPO is making people go crazy. At the same time, it's a little bit of a sophisticated thing, right? And then even people at the SEC say, well, if you're going to have a tokenized equity, it should have all of the aspects of an equity. And how do you think that's going to develop?
Sure. So I'm the area that as probably indicated earlier too, but as my general least interest, but also probably weakest, is general regulatory frameworks. However, I think if I think about it purely from a commercial perspective, my take on this would be, what is the direction of travel? We want equities to be available to trade 24/7 and for everyone. Imagine that's the world, right? So I don't have to, it's not that, and KYC, AML sounds like these other guys who can't do this are, in some ways criminals. But we're just talking about ordinary folks, like, an 18-year-old kid who's in university wants to trade some equities. It doesn't know or doesn't have a driving license yet, or, exactly. To onboard onto these TradFi platforms could be difficult. So given that the objective is to get the exposure of equities, because it's not the actual equity, clearly. So it's the exposure of equities, for example, to kind of streamline it, in the hands of everyone all the time. So if this is the objective, the very crypto native technology of perpetuals is actually in some ways, and that's, as you said, you asked my view, I think it's much better at achieving the same thing. While you can tokenize stocks and so on and so forth, it is a more complicated wrapper to, if that is the objective, I think the traction will be a lot more. And both will have their places because some might want to hold the actual thing and for various reasons. But I think the exposure of various things to come to a 24/7 market to everyone will happen a lot better, a lot faster with the perp technology than with any other technology, in my view.
Mm-hmm. So we talked about risk, and that's your bread and butter, helping people manage risk. Just talk to us about, again, those conversations with clients and what they're looking for from you, but then how more generally they're thinking about risk, whether it's counterparty risk, market risk, settlement risk, operational risk. They're looking at all of those things. Some of those they manage through you, but some things not necessarily. What is their perspective on the different kinds of risks and how they're managing that?
Yeah, sure. So on the risk side, I think a lot of those guys they're very sophisticated when it comes to things like market risk, counterparty risk. I would even go as far as saying settlement risk, definitely operational risk. So these guys have decades-old procedures around all of those things, and they may be a bit inefficient, but they definitely work. And inefficiency normally is
in normal assets.
In normal assets. Yeah. Now the thing is that to get your head around what you're dealing with, I think the first thing, and this is I'm sure in crypto circles being talked about for years and years, probably one of the most important thing is about the risk that is entailed in crypto space is that it's a bearer asset. And that is probably at the heart of much of the risk, is that you know everything about how to, if you owe me a bearer asset, I'm only taking your credit risk. If you're an institution and I'm an institution, right, the fact that you owe me a bearer asset really doesn't mean much because you owe me something. It's worth $10 million and you owe me $10 million worth of thing. Mm-hmm. So, the only way this relation can break down is you defaulting. Mm-hmm. You're actually going bankrupt. So that framework of the traditional finance world is very much applicable to everything, except that the chances of, if you were to actually lose the $10 million worth of Bitcoin that you owe me, there isn't someone who can just kind of give it to you. They can't be created. There can't be no lender of last resort. So the problem entails from that nature of that thing. That's one important thing. So I think everything that else generally works around this. They're very sophisticated and they know how to manage their risk. And a lot of times, for example, and this is why, for example, Haruko is built out to show you your market risk, your scenarios, your various kind of stress formations, your the more traditional VAR and so on and so forth. All of those things you can see. And then there's operational risk. You also want to see, the credit risk side, but you want to be aware that the credit risk is something that in some cases it's not going to be something that someone can make whole. Mm-hmm. So a lot of risk comes from that. But I think when I talk to a lot of these guys, particularly the guys who are sort of either just dipping their toes or kind of are thinking about starting off, one of the things I would say is that having seen this space for the last decade, people who are successful in this space have kind of come to terms with risk. Mm-hmm. And it's very important because, sort of like having a bit of physicist in me, I'd say, risk like energy only transforms from one shape to another, mm-hmm. but it doesn't actually disappear. You can't create or destroy risk per se. Maybe you can create risk, but it's not easy and it's not as hard as energy, but it's pretty, you can only mostly hide it. Mm-hmm. You can put it behind something else. And I think the more you put it behind, the cost of hiding that risk is actually very high. Mm-hmm. So a lot of people will come in and let's say you choose a custodian and you're like, you choose the absolute best custodian in the world. But that custodian is, imagine, the single largest custodian of everyone in the world. You need to know that there is a risk attached, right? Or, for example, you choose a prime broker. And these things aren't taking the risk away. They're just only dissipating the risk and putting it in different places. And if you forget about the risk by putting it in different places, when it does at some point, as risks have a habit of blow up, you wouldn't even know where it was, why it blew up. So I think the conversation around a lot of these guys is also to convince them that not every risk needs to be hidden away. A risk in plain sight sometimes is actually better than risk which is kind of deeply put away in some place. So a lot of these guys would be, I think you can get compensated for holding that risk and also be aware of what the risk is. So they look at market risk, counterparty risk, all of those things which are very kind of normal to them. They'd be worried about the custody risk and the settlement risk. There is also in the counterparty sense, there's also this big problem of they can't onboard certain people, even though they'd be in the largest crypto space, they're household names, but a very sort of like top tier bank would come in and say, sorry, I can't deal with any of these guys. And all of a sudden you've killed, maybe there's a balancing act because you might have removed a ton of counterparty risk in your model, for example, but you've added a ton of liquidity risk because this is 75% of the liquidity you've taken out by saying I can't take counterparty risk. So you have to balance those things, and a lot of times for those guys, I think partners like us and other industry colleagues are people who they use as sounding boards to develop a framework for what kind of risk we should hold on to, what is a risk that we'll be amply compensated for, and what is a risk to kind of pass around in other places, and what's the trade-off between those risks. I mean, counterparty and liquidity it can be a big one. A big one.
Yeah, I mean, probably some of those maybe who were stepping into the space around the time that FTX was doing business were, I would assume, not aware of some of the risks that were inherent in kind of the model of, exchange play and bank and assets being mixed, and some of them being used over here on the side as a hedge fund, and actually then your exchange is your market maker at the same time. So as you say, bringing some of those risks out clearly so people understand the model, and then somebody like a UBS can decide, well, do I want to do business with a household name, but yet this is kind of the setup that they use. So that transparency in the risks and making the trade-offs is sure very important in general.
Yeah, no, absolutely. And I think also as you kind of live and learn, and when FTX was around, I think if you asked anyone who was quite institutional that they had to choose between something like FTX and Binance, the answer would have overwhelmingly been FTX, because it was great looking technology. It was on paper great kind of credentials of founders. It was a lot of those things. So I think it's almost like a wake up call that our kind of traditional due diligence processes aren't necessarily set up, like the same lens actually doesn't see the risks that exist. So on paper, through the traditional lens, a FTX was significantly less risky than a Binance. Obviously, history has proven otherwise. But it's definitely a wake up call that we need to figure out what is the due diligence lens enough. Maybe the lens needs to be widened or be more focused in certain areas, and that requires a lot of knowledge of what is the risk that we're dealing with.
Do you think there are some things like, for instance, separating market maker duties from exchange, things like that, or getting rid of the pre-funding thing? Those are things that are kind of taken for granted in TradFi, now becoming more common, I guess, in the crypto space. Is that going to help to alleviate risks and help people to make better decisions about what they do?
Yeah, I think absolutely. I mean, I think there's like good things about crypto. There's terrible things about crypto, and similarly, there are some very good things about TradFi and otherwise too. And I think this, if you think about the breakdown of the stack of, for example, exchanges, how a venue is a different thing compared to a market maker and a broker, and you've got all these players. It's almost like decentralization, right? in TradFi, and it's decentralization adds resilience to any system. And it doesn't have to be set in code for it to be decentralized. So I think it's almost like, it's really funny, but you started off with building out this decentralized world, and the place where we traded this was basically the fully centralized, amazingly combined world, and now we're piece by piece kind of trying to pick it out to make it into these appropriate. So I think that stack of traditional finance is definitely something that is going to be very helpful. That part, I think, has lived for a long time in traditional finance, and it's for good reason that we split up these things, and you have multiple brokers, you have multiple venues in some cases, and within those the kind of the duties are well segregated. So that will definitely improve things in the crypto space. But I think it's because the crypto is such a specific thing. I think a lot of times it's not about the kind of the words, but actually kind of making these things in place. So there's lots of ways you can do lip service to these concepts without actually doing anything. One thing I would say is because it evolved from the retail space, which is why some of these things, like nobody cared about, my broker is the same as my venue.
Retail people don't do risk management so much.
No, exactly, and that's how kind of all the retail world sort of works. But that meant that the liquidity actually got really sort of concentrated in certain parts of the ecosystem, and that by itself then becomes a magnet. And you can't, like, while we're sort of like segregating this stack up, whether we like it or not, we have to worry about this this liquidity. We have to think about how to approach this liquidity problem. Because if we, in the process of segregating stack or deciding, who are, A+ actors or A+ credit in the space, if we get rid of a ton of liquidity, it is a good practice only on paper, but in reality, you're probably going to see a lot more risk issues because it's something that you've sort of like not really taken care of in doing that process.
Yeah, I mean, liquidity risk is a huge thing, and people want it to be liquid, right? They want guaranteed firm liquidity, know that it's there. That segues a little bit into another area. I mean, you come from TradFi, as you mentioned, Goldman and Deutsche, and all of these big names where you've been. I guess, as you mentioned, others as well. Was it Thomas from B2C2?
Yes.
You were also.
Yeah, Duma and I were colleagues. We sat like a couple of seats apart on the FX trading desk back in the day at Goldman.
And what do you see like similarities and differences from kind of a market structure? Liquidity being one thing, but also, just the roles that different people are playing, whether it's brokers, whether it's market makers, similar and different from FX, equities. I mean, people have made the point that crypto is somewhat like FX, but not completely. And how is this kind of developing?
Yeah. I think because it's sort of like it has its waves, and people come in from different parts of the market and sort of like try to understand this in different ways too. I'd say when it first started, obviously because it was called a currency, a cryptocurrency, and so it was very much a focus on currency. I think that probably brought in possibly a lot of people from FX. It also made them feel like they were doing something in addition to euro dollar and cable. So it was very much, it felt like FX. I think there are certain things which are which also make it look like FX, and I think the most important of them is when you think about the original or the early trading, particularly the derivatives trading. The early part of the derivatives trading was all inverses. And then very soon inverse perps and also inverse options, but inverse perps, let's say. And that is sort of like a concept which is absolutely alien to anyone, any other asset class except for FX. Yeah. Because, you never trade Microsoft share and earn Microsoft profits, P&L, right? You never trade oil and get some more oil. But in FX, for the longest time, we've been trading dollar yen and get more dollars. So it's very common to trade, to have your P&L currency same as base asset, which is a concept that in all other asset classes sound really strange. So I think that aspect of particularly the derivative trading in crypto definitely started the early doors of it being like an FX derivative a lot more, because you understand it a lot better. I mean, things like net delta on premium currencies is something that an equities trader would be like, what is going on? Because you pay premium for a Microsoft option in Microsoft shares, your delta is different from what you think your delta should be. So all of those things are in the derivative space. I think the FX guys initially had an advantage, and so there is some similarities there. However, I'd say particularly for Bitcoin, the thing that really kind of is not in line with FX is what currency appreciates like thousands of percent in 10 years, right? There is no such currency, but there are
and
many.
volatility like crazy.
Yeah, correct. Volatility like crazy too. But I think importantly, I'd say I much more concentrate on the mean return of Bitcoin than on the volatility of Bitcoin. But to say there are large number of stocks, the big tech stocks, for example, have rallied thousands of percents. So I think there's an equity guy has a lot more advantage because they understand that things can go like zzz, as opposed to things always going like this. So I think the FX world understands the structure for example, as I said, the perps, the trading in base, but the core asset is not like a currency yet. And maybe in another 10 years, maybe at some point it will be like a currency. But right now, or from the inception to now, it is like a rallying asset versus the fiat currencies. And so I think it's a lot more like an equity in that way, where it basically goes up. And then these days, obviously, it particularly behaves like equities where it comes off on risk. And so, everything it looks like equities. The downside puts are well bid over. So the options market structures like equities, and the behavior of the underlying is like equities. So I think both sides have something to kind of add. But I think also with the OTC market developing, the fixed income and FX guys have a lot more ability to sort of or experience in that space where you can do any date, you can do any strike, you can do any kind of structure, and also add a knockout and a knock-in, and you can do whatever you want. Whereas equities are a lot more exchange traded.
And also, understanding those different characteristics all at the same time and tracking the risk of those different things, and that's probably a perfect situation for a Haruko to come and say, we give you the complete view, because somebody who is only from FX in the beginning and now is trading crypto, or somebody only from equities, they have a hard time wrapping their head around the entire
absolutely
space. Yeah.
No, absolutely. I think that is definitely one of our superpowers. But I would say very much over years that superpower has been developed and honed in conjunction with our clients. Because so I have a background in FX, and I'd say some of what I say is what I've learned along the way, not just from the market but also from my clients who come from equities. And so, for example, as I say, an FX guy can't imagine something just going one way completely. Some emerging market currencies have in the past, but still not thousands of percents normally. So it's a thing that you kind of learn. So I think the expertise that we have at Haruko is also a function of our client base. And that's why it's a cycle that really kind of propels itself, where you go and you're adding some value to a client who's definitely adding value back to you as a product, but also as a firm, as the intellectual capital that sits around the product, and then you can serve the next client better, the next customer better.
You mentioned OTC, and that plays into a little bit the idea of how the market is, the structure, and so on. You've had CLOPs for kind of the retail exchanges. Of course, maybe bigger institutions prefer bilateral trading and so on. And then there's different aspects of risk. Just talk to us a little bit about how you see, CLOP and OTC and what people are looking for in both spaces. I suppose you, as a platform and connected to different exchanges, maybe you help your clients also do a little bit of know your venue, kind of to understand, this is how they do it here, and this is the advantage or disadvantage, and so on and so forth.
Sure. Yeah, I think both certainly have a place, right? So there are clubs and direct one-on-one OTC. I think both things will have a place, and they, in my view, will remain. And again, this is also one of those things where the evolution of the space is potentially ahead of, in some ways, the evolution of traditional capital markets, where capital markets have found their places. FX is largely completely OTC, whereas equities is largely heavily exchanges and so on. But this doesn't need to be one or the other. So I think both will find their kind of place in that way. Where our journey started in terms of there was very very little OTC in the crypto space before. There was a OTC, I should take it back, but there wasn't like this vision that OTC will be a big thing in crypto before FTX. And I think at the point of FTX, we as Haruko kind of team, we got together and we were thinking, what is the future going to look like? And we felt there were two kind of paths. Either the future will look a lot more DeFi, or the future will look a lot more OTC. And obviously there will be better quality exchanges and so on and so forth will come up naturally. And I think again, following how the development happened, we actually developed both of those sides. But then picking up on what our clients were doing or what our target clients were doing, we picked up a lot on the OTC side, a lot more than the DeFi side, because we figured this is where everything is going for the institutional folks. And that has kind of, that bet has really paid off, because I think today, literally everyone pretty much, who is setting up a large capital markets business in an OTC format is a client of Haruko's, because we have a background in that space and we understand that space well, and that's what kind of they're trying to build out. So we think on the OTC side, those guys are very knowledgeable. We obviously kind of contribute to that knowledge, but we have a product that really fits them. On the venue side, you can imagine there are venues and then there are venues. So there's a huge spectrum of things. And people who are more sort of crypto native institutions now, like public organizations, some of them, they're large, and they will take that measured risk across the spectrum. So, the same guy who wants a very regulated venue for certain activity also is happy maybe through a different entity, but in a venue which is a lot less regulated, potentially a lot more risk, but there's a lot more money to be made. So I think the risk-adjusted returns, I'm sure they run their own analysis on those kind of things. But I think every one of those stay and have a place. I'd say the venues which are right at the top of that space, which is venues that are very nicely regulated and so on and so forth, are commercially generally not like that. I don't think that is generally optimized. So I think we probably need to come off that spectrum to a point where the commercial, we're really just at the point where it's commercial enough, but it's also clean enough and risks are taken care of, but staying commercial. As an example, I'd say, for example, to take crypto collateral or Bitcoin collateral for someone like a CME is critical to unlock this space. So that is one thing, a venue that allows you to post Bitcoin collateral and still trade in a very safe and regulated environment is, I guess, you've got Deribit now moved into Coinbase, so that you could say that is happening. But I think that was a space that was not served enough, and I think the market evolves to fill it. And
kind of the flavors of OTC and the way people are doing that. I mean, there's RFQ, there's RFS, there's I settle first, you settle second, this kind of thing. How are people dealing with that, and what are they looking for when it comes to working with high quality OTC marketplaces, and now we're thinking really big institutions or big trading firms?
Yeah. So I think a large part of OTC for big institutions or trading firms in this space, when they're facing smaller or less sophisticated guys, is very simple. The balance of power is very clear.
We're in charge.
We're in charge. We're going to tell you where the valuation is. We're going to tell you where the price is. We're going to hold all the collateral, and you're going to get what you asked for. So it's you have to be
not very fair or nice, but
no, exactly. But this is the thing about business. It's not like robbery, but it's within rules. You will the most important thing you're doing is just commercially covering what you need to do. So I think this is a large part of what I see or hear around the ecosystem. A large part of OTC trading is happening in a fashion where the two parties aren't quite equal. And to the extent that the trading houses are in charge. Now, I think as the institutions come and they deal with these trading houses, obviously it's almost like they're now expecting the balance of power to be completely opposite, where they're going to now dictate where things are and who holds collateral and so on and so forth. And I think that will be a tussle, because they might find it that liquidity is actually because eventually, this is kind of, it all boils down to some degree to some cost of funding, the balance sheet. Yeah. And that is reflected in price. The guy who basically, imagine the guy who buys BTC off me and settles like today, is very different from the guy who doesn't settle for 1 week, because literally borrowed dollars from me for 1 week, and those dollars are worth 15% return in the
as a
the
price,
market. Exactly. So a lot of that has to kind of, I think it'll happen. My view is that the both sides will probably settle a little bit to understand that while sort of like these very large new institutions, when they come in, they will have power, so they will kind of reset this relationship, but also they will also recognize that the other guys also have enough power that if they push it too much, then their liquidity becomes worse than it should be. So I think we will, for the first time, as large players start properly offsetting risk against each other and so on, we'll start seeing a market which is more even, where sort of bilateral two-way margining happens. For example, we are building out generally for folks. Generally, margin models have largely been one way, but now there's a lot of demand for people who are like, okay, do two-way margining. Collateral was generally something that you posted and never received any interest on, and now a lot of those are actually, they want collaterals both ways. People are sort of modeling total return swaps in more traditional ways. To effectively replicate the perps. But all of those things are now happening, where I think the documents will look, in my view, a lot more like OTC documents in the traditional space.
Yeah. And I suppose for the really big players, you think a big bank, they're not going to want to be locked into just one OTC partner, probably, right? They're going to look for multi-dealer markets and equal footing, as you say, firm liquidity. But something where they feel respected and served very well. Yeah,
absolutely. And I think we've seen some of that. I mean, obviously B2C2 was bought out by SBI. It's been a while, but we haven't seen the kind of the JRN moment of the space, where JRN's bought by Goldman, and O'Connor's bought by UBS, and all these trading firms were in a way bought out, particularly in the commodity space or in future space, taken out by large quote-unquote investment banks, which became then trading behemoths. So I think there is definitely opportunity still for some decent-sized trading operations to be taken into whoever wants to kind of come in. And yes, so I think that's something that is still probably on the
horizon. And speaking of on the horizon, we often finish up by asking guests what they're looking at that maybe nobody else is talking about, they think might be coming up, whether it's short, medium term, or even long term. I'd be interested to hear your thoughts about that.
I'd be giving myself too much credit to say that I'm thinking of stuff that other people aren't. But if I was to, there's not a very specific thing, but if I was to think about one thing, I think what we talked about earlier, as we had a kind of a white space in the crypto space, and people came mostly from traditional finance, brought all that knowledge, and also folks who then got their hands dirty deep in sort of stablecoin yield farming to understand everything in the space, and now more and more things like perps, but then prediction markets. So you kind of open up the world to all these little pieces, and I think you've built, or I would say we together as an industry have built a understanding, a knowledge of the space, which is both traditional and crypto native, and very sort of forward looking. If prediction markets are predictions rather than gambling, we're happy. This set of people who are very sort of agnostic to really, they're not driven by status quo. And I think this set of people, in my view, to answer your question, in the next sort of like medium term, I think they will, in lots of different ways, contribute to, build into, and potentially take over some of what looks like traditional today. I think there will be a kind of a reverse takeover, if I make a sort of sensational prediction, by this group of people or group of companies that has been formed in the space in their own ways. So trading firms, technology firms. I think the technology that's built out in crypto will, some of the very best will, in my view, engulf the technology stacks that have existed for 50 years, patch on patch on patch and patch on patch to do what needs to be done, and it still does it, but you can compress it, build it cleanly, and start building on top again. I think this, for example, for trading firms, because trading firms are lean, they have operations, they understand the front office by design has had to understand the back office and settlement. Whereas, for trading FX or even equities for 15 years, you may still not fully understand how the settlement happens. Whereas in crypto, you do it for a year on some decent chunk of your own money, and you know everything because you have to know everything. Otherwise, you would have lost money. So I think this set of people will, take over / build out, and while the sort of like the institutions are coming this way, I think there is definitely some
crypto is coming
for sure. Digital assets coming the other way too.
Very, very interesting, and I'm sure probably you're seeing Haruko being part of that wave, moving in and taking over, so to say.
Absolutely, that is our attempt, and we hope we'll be successful at it.
Very good, Omer. Thank you very much for joining us today. Very interesting to talk about various things, and I'm sure we'll catch up again very soon.
Thank you, Ian. It has been a pleasure being here.